Hi guys, and welcome to this month's edition of the Zupa Report. This is where we run through everything in the report, from property supply, demand, house prices, what it means for you from a residential buyer, and also what it means for you from an investor. Now, what I'm going to do today is go through a little bit more detail about the supply, a little bit more detail about the mortgage rates, because that's what's going to impact the market over the coming sort of months and next couple of years. So look, without further ado, let's tuck in. So first things first, as you can see from the report here, the annual house price inflation is now at 1.2%. Now, we do have some people asking, why is it still going up? It's not that it's going up month to month, it's that from one year to another, it's increased. So that's what we have to sort of take into consideration. But the headlines are this. We've got 42% of sellers are actually accepting discounts of more than 5% off the asking price. Now, whilst that might sound alarming initially, what we have to do is take into consideration that people have still chanced their arm. There are a lot of properties on the market that have been on for over 6-7 months. Why? Well, because the agent overinflated them in the first place. So what they have to do is take a 5-6% haircut, and then of course that then falls into this category where we're seeing 42% of sellers discount their property. And we've got an 11% hit to buying power as mortgage rates rise from 4 to 5%. If we start to see them increase more, up to 6%, we're going to show you a chart in a minute, which is a great indication of what you could have afforded and what you can afford now if rates get up to 6%. But let's head into the actual headlines. As I said, house price inflation here slows to 1.2%. Quarterly growth rate turns positive. There was a pickup actually in sales in the spring. That's the norm. Over the winter, things quietened down quite dramatically. But over the spring, things have picked up. And what we can see here is the number of sales picked up, and of course, house price inflation has kicked on again. However, the quarterly price falls are set to return for the second half of the year, because mortgage rates are going to hit your buying power by up to 20%, which we're going to come on to in a bit. There's a big jump in proportion of sellers having to accept discounts over the sort of last couple of months or so. What we are going to see, we're going to see this more and more, and I'm going to talk in a bit of detail about this now, because what you have to consider is over the past few years what's happened. So a lot of people have short memories, they can't either remember what's happened or they don't look back on the data. The reality is, when COVID hit, the moment we came out of that first lockdown, there was a huge need for space. Every newspaper was reporting it. Everyone wanted space. So what did? They moved out of the cities, London behind us or Canary Wharf behind us. They moved out of the cities, whether that be Manchester, Liverpool, and they moved into the suburbs. So that created a number of prime properties to buy in the city centres. So investors were actually tucking into the city centres at the time because there were good bargains to be had, and everyone had this need for space. So then what they did is, over the period of 2020 to 2021, they signed these 2-year mortgages, these 2-year fixed mortgages. Someone might have had a £900,000 property, for example, and they've gone and paid $1 million for it. They were paying over the odds for their particular properties, 10-15% above and beyond. So there's a case that I know with a client of ours. They had a great property in Canary Wharf. They sold it at a discount in Canary Wharf to get some space in Oxfordshire. It was a £900,000 property. They bid $1 million on it and they won that bid. But they've now got a £500,000 mortgage on that. Now, when they first signed, that mortgage was at 2.5%. No problem. The affordability was there. So you're approximately looking circa around about £12,500 a year, what they were paying. Now, that mortgage is coming up for renewal. The problem that they've now got is they're probably looking at 5%. So their mortgage rate's doubled. They're now looking at £25,000 a year interest alone, plus the repayments. So what they're looking to do is, they're now saying, well, actually the affordability for the mortgage isn't there. We wish we would have stayed where we were. So now they've got to sell. The problem is, with the house prices the way they are, it's probably still only worth 910, 920. But because they need to get rid of it before the winter, and in the winter things don't move as quick, what are they going to do? Well, they're going to probably discount it to 850. So they're 150,000 down on their initial property, and that's a residential property. So what we're seeing is a number of mortgages that are starting to need renewal this year. That's what's impacting. Why have we still got high inflation as well? Well, one of the major reasons why we've got high inflation is that raising interest rates is kind of a bit of a blunt tool initially. We need it to affect people in their pockets, and it isn't yet, because so many people signed 2 to 5 year fixed mortgages back in the day. And of course, they've got extremely low rates. So if you've got signed a 5-year fixed mortgage back in 2020 or 2021, well, you're not going to have any issues until 25, 26. So that's what a lot of people did at the low rates. They signed for the 5 years plus. So the reality is that we might see that inflation kick on a little bit longer because people simply aren't feeling it in their pockets at the moment. Energy's come down, petrol's come down. So where are we seeing inflation? Well, we're seeing it in leisure, tickets, cinema, shows. People are still going because people actually still have money in their pockets. So the reality is that inflation is still proving a bit stubborn, and part of the reason is due to these 5-year fixed mortgages that they signed back in the day. So as we sort of head on, what we can start to see here is the UK prices, according to Zoopla, are still on track to fall by 5% over 2023. I think we might be slightly pleasantly surprised. I don't think we're going to see that up until the end of the year. I think what we'll start to see is maybe a couple of percent fall. I have said before that there potentially could be a slight increase depending on what rates are doing, but only time will tell over the next few months what we're going to see with the rates. And a further downside of risk if we see an acceleration of supply. Now, I do think we will see an acceleration of supply. Why? Well, I think because two things. First of all is that a lot of the tools that were down during COVID, they were picked up after. We're now starting to see those properties come onto the market. But also we're seeing people who simply don't have the funds to renew their mortgage and remain in the property, like I explained before. So they're going to start to come onto the market as well. But that will be a certain type of property. We're not going to see the investment city centre 1-2 beds come on. It's more the 3-4 beds, 6 to 900,000. All the need for space. I think we're going to see a lot of those kind of properties coming on, and that's going to drag the market down. I say to people a lot of the time, just because you see the market falling overall, it doesn't mean it's falling everywhere. Because if you've got a fall in London of 5%, and you've got a flat market across the UK, the reality is the market will still fall because London weighs heavily on the rest of the market due to the amount of money in London and the value of the property. So just because you see a fall, don't think the whole market is falling. There's still pockets which are actually still increasing. So let's look down. So first of all, mortgage rates are rising beyond 5%. The moment you see headlines like that, everyone stops. Everyone stops. They pause. They stop buying, and they think, well, let's let the dust settle over the next sort of 4 or 5 weeks. Mortgage rates have increased by over 1%, now averaging between 5 to 6. They should calm down a little bit over the coming weeks. But there's a great chart here in terms of affordability. So whereas at 4%, your buying power was at 195,000. So think about a first-time buyer here. A first-time buyer heads into the market, they've got 195,000. Well, the moment the rates hit 5%, their buying power is now only 174,000. The moment it hits 6%, they're actually only at 157,000. Now that's key for the market that we deal in, because first-time buyers is what we aim for when we're looking to rent our properties. So if you've got a first-time buyer who can, a year ago or 6 months ago afford a £194,000 property, and then now can only afford a £157,000 property, well, what do? They either carry on living at home or they carry on renting. And we are seeing increased amount of demands for rent. We've got 100% occupancy over all of our traditional let properties, which is phenomenal across the amount of properties that we've got. Typically it was always 94-95%, it's now 100%. The moment we put a property on the market, we have on average 19 applicants for that particular one property, so we can pick and choose who we use, and that's driving the rental prices up. And what does that do? Well, it means that people actually have less savings because they've got to pay more in rent, so they rent for longer. So actually from an investor's point of view, it's still a great market. And another reason why it's a great market is because there's bargains. Developers aren't immune to these headlines. They're reading the headlines, so they're willing to let the prices go a little bit cheaper. So not only have investors got higher rent coming in, they've also got better bargains when it comes to the actual purchase price. So it's a dreaming market for investors at the moment, but not if you're looking for a first-time buyer, and not if you're a residential client. Then we sort of head on to the actual mortgage rates and what's going to happen now. What do we think is going to happen? Well, in terms of the futures market, if we look at the interest rate futures, they're not looking to diminish too much over the next sort of 6 to 12 months. But if we wind forward 2 years, the summer of 26, 3 years, sorry, summer of 26, we are looking to see those back down to 4%. I think once inflation erodes, we should start to see it fall slightly quicker than that. But the reality is we are where we are at the moment, and it's a tough market for those first-time buyers. We did see sales momentum recover. We typically always see that in the spring and the summer. Mortgage rates were around 4% the early months of 2023, people then started to think, well, you know what, it's now or never basically, let's go for this, and they started to sign up for 2 or 4 year deals at that 4% mark. And of course, in hindsight, that looks a bit of a good deal, especially with mortgage rates hovering 5 to 6% at the moment. Now, we are going to see, if you look at this last paragraph, the last 2 weeks, there's been some early signs of a decline in demand. Well, that's standard. Whenever you see a dramatic change like what we saw in the bank rates and then, of course, the actual mortgage rates, there's going to be a decline, like when we saw back in the mini budget. So we wind back to September last year, we saw that mini budget, which is going to be infamous for years to come. The reality is everyone stopped, mortgages were withdrawn, and one of our close mortgage brokers, same thing, he literally couldn't get a mortgage. Day by day, lenders were pulling from the market, coming back a week later once they've sort of rejigged their figures and realised where they were. So we are going to see that, but heading for July and August is normally a bit of a dip month because obviously a lot of people are on holiday, but I do expect the demand to start to push up in July and in September as well, but I do expect a fall in the winter months as well. Now, in terms of cities, where should you still be investing? Now, forget the residential side for the moment because we know it's a tough market for you guys, but in terms of for you guys who are looking for an investment, as I said before, if you're looking to get a deal, now's the time to get that deal. We always say to people, so many people, amateur investors, this is aimed at, so many people literally stop when the market is, whatever market, by the way, whether it's a property market or whether it's, of course, the stock market. What do? Well, they simply stop. When the market's falling, they stop. Wind back to COVID. Have a look at what the stock market did and what did you do at the time. So many people didn't invest when the market fell, and that's the prime time to invest. The same as now in the property market. There's negative headlines. Use those negative headlines as leverage against the developer, which is what we're doing. And we are constantly seeing 5, 10, 15% discounts given, which is phenomenal. And in terms of that, you've also got increased rental. So people, whereas before, wind back a year or two, they were making 4 or 5% on traditional lets, we're now back to the stage where we can see 7, 8% on traditional lets in certain areas. We've just had one complete in Manchester. They're getting 8% on traditional lets. So that's a phenomenal rate of return, providing you get the right property at a below market value price and increased rent. It's a perfect storm for investors at the moment. Now, as we sort of head to the cities where we're looking, you can see down here, it's still the same cities. We've been doing these reports for years. It's still the cities, whether that be Nottingham, Birmingham, Sheffield, Manchester, Leeds. It's the northern cities that perform time and time again. You could pretty much stick a pin in the top 10 and you're bound to find a decent property within any of those areas. But it's those areas that you want to be looking at. Again, it's London. If we head down to London, you can see that we're looking at minus 0.2% as people start to realise that when their mortgages expire on a £1 million, £2 million property here, they're going to have some chunky repayments. So it's still the northern cities. In terms of the overall outlook, guys, look, the resilience of the housing market is set to be tested. It is, we've got no doubt about it. It's the mortgage rates that are going to test it. I don't think the Bank of England have got too much scope now to keep putting rates up. I think they're kind of pushing their limit of where they can go to. But I do think once the dust settles, we're going to start to see things come down nicely. But there is a large equity buffer that's going to absorb house price falls, making the risk of negative equity smaller than in previous downturns. That is key. People have got more equity at the moment than they did previously. So there's a little bit more of a buffer. So we're not going to see a 2008, 2009 crash or a 1988 to 92 crash. But the biggest challenge is going to be obviously those monthly repayments. The reality is inflation is here. It's sticking around. It's a bit like a bit of glue at the moment. And why? Well, as I say, because people have still got money in their pockets. If people stop spending, then inflation will erode slightly. But if people have signed those 5-year mortgages, as we say, they're not feeling the pinch yet. They're going to still be going out and doing all those leisure activities. But overall, tough market for residential clients. Fantastic market for investors at the moment if you can pick up that bargain. And of course, if there's anything you need from us, just give us a shout anytime. Take care. Bye-bye.